Tariffs are bad. That's what most economists tell us, but I'd argue that it's not quite so black and white. Could it be that some aspects of tariffs are actually quite good? In this video, we'll talk about 5 of those potential positives, and I'll end with my take on tariffs and also how they could affect our investments. This video is sponsored by Raisin UK, the free, easy-to-use online savings marketplace. So let's start with a definition of a tariff so we're absolutely clear. It's a tax paid by an importing company to its government. So it's clear that the importer is paying the tax. So if the US charges tariffs on imports, its own domestic companies are the ones which are paying that tax. It's not a tax burden on those foreign companies which are exporting to the US. So certainly on the face of it, it looks like it's a tax which is paid by Americans, and that seems quite negative. But I think there's a case to be made for some positive aspects of tariffs. And I think the most important one potentially is using trade tariffs as a bargaining chip. So here are the US's trade relationships that you can see graphically. The size of these arrows shows you the volume of trade which goes through every year. Imports are in a light colour and exports are in a darker colour. And the first thing to notice is that trade is geographically driven. If your country is close to another country, chances are you're going to trade more with them. And of course that means that the US trades most with Canada to the north and Mexico to the south. But there's also a lot of trade across the Pacific to countries like China, Japan and so on. And certainly what upsets President Trump is that they have lots of imports from China but not many exports to China. And he sees that as unfair. But what this also shows us is how much of a big deal it is if a country has tariffs imposed on it by the United States. And the key thing here is what proportion of exports are sent to the US. And you can imagine that for countries like Mexico, where 81% of its exports go to the US, or countries like Canada, where 76% of its exports go to the US, then tariffs are a really big deal. Just a 1% increase in tariffs for either of those countries would be a problem for their economy. However, if we go down the list, you can see that countries like China are much less affected by tariffs imposed by the US because they're further away from the US and most of their trade is with their neighbours. China, for example, exports mostly to Asian countries which are nearby. The UK and Germany export mostly to Europe. So certainly for the countries at the top of this list, tariffs are a very effective bargaining chip for the United States. And it's unfortunate that China is actually well down this list. Today's episode is sponsored by Raisin UK, the no-fee online savings platform. If you're like me, you want to get the most from your savings, that's where Raisin UK comes in, a free-to-use marketplace that makes growing your money simple. Raisin UK offers access to a huge variety of savings accounts from over 40 FSCS-protected banks and building societies, all in one place. No need to hop between websites comparing rates, they've done the hard work for you. You can find everything from easy access accounts to notice accounts to fixed term bonds with competitive interest rates. And the best part? It's completely free to use. Once you've registered, you can manage all your savings from a single dashboard. Simple, streamlined, and super convenient. At Raisin UK, all of the savings accounts offered are protected by the FSCS or European Deposit Guarantee Scheme, DGS. With FSCS protection, if you hold money with a UK authorised bank, building society or credit union that fails, you'll automatically be compensated up to £85,000 per eligible person per bank. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link in the description below. Now the second positive I think about the US imposing trade tariffs on China in particular are its unfair trade practices. Now if you are a company doing trade with China, it is very difficult. And I think one of the main problems is the fact that China does not protect the intellectual property of foreign companies. Here's an example from the BBC's website, a news story about authorities having to close down a fake Louis Vuitton shop and also Prada shops. Fortunately, the shops were closed down very quickly, But if you're a fashion brand or a tech company, then I don't think it's the case that you can really rely on Chinese authorities to look after your intellectual property. And it's not just about money. Here you can see data from the EU Intellectual Property Office, which breaks down geographically dangerous fakes. What would that be? Well, it could be things like fake pharmaceutical products or food products, or it could be automotive spare parts or fake batteries which blow up, or maybe fake chemicals and pesticides. All of these pose a risk to the public if they import these fakes to their country. So both in terms of number and also share of global seized value, you can see that China leads the world in these dangerous fakes. Another huge problem is forced technology transfer, so that if you want to export to China, they may insist on the fact that you share your secrets, your corporate secrets, with them. And of course, the reason for that is that they can actually take that technology and develop it for themselves. That could also be in the form of having to set up R&D departments within China where they can be more easily monitored, let's say. Now in 2019, as you can see in this quote from the UK government, China did pass this foreign investment law, and notably that happened after Trump's first set of tariffs on China. That's not a coincidence, which in theory at least protects intellectual property and stops this forced technology transfer. However, if you look at this list, which is published by the US Trade Representative, that's the USTR, in 2024, China was still on their priority watch list, which is defined as countries with serious intellectual property rights and deficiencies requiring increased USTR attention. And in the report that went along with that list, the USTR pointed out that the pace of reforms was actually very slow. Stakeholders, which is companies that trade with China who actually know what's going on, acknowledged some positive developments, but continued to raise concerns about implementation of the amended criminal law, copyright law, and patent law. So there are still problems with forced technology transfer, trade secrets, counterfeiting, online piracy, copyright law, and patent and related policies. So I'd say it would be a positive for the world and in terms of safety of exports from China for the Trump presidency to enforce some of these changes. The first one we've already discussed, intellectual property should be protected by China. Secondly, an anti-competitive practice which China does in huge scale is subsidizing its manufacturing, for example. All countries do this to some extent, but China does it to just a huge degree. Furthermore, the regulations for companies which export into China are actually rigged against those companies. For example, if you export in one of the pillar and backbone industries, for example, the automotive sector, chemicals, construction, electronic information and so on, and more recently green technologies like offshore wind power, it'll be very difficult for you to export into China. Now, when it comes to currency restrictions, I think there's less of a case to be made here. What China actually does is to maintain its currency, the renminbi, against a basket of its main trading partners, which the US, remember, isn't. So what the central bank tries to do is to keep the renminbi within a range, a band, relative to a basket of those currencies. So I'm not convinced that they're devaluing the renminbi relative to the US dollar in order to make exports to the US more attractive to consumers in the US. But what is true is that they have overcapacity in many industries, particularly those green industries. Furthermore, they do dump excess production into countries like the US and Europe and the UK. For example, the EU put tariffs on EV imports to Europe, and one of the reasons was this dumping of excess production. So I think countries like the UK depend on countries like the US, which have huge global trade heft, to put the screws on China and try and change its trade policies to be more fair. The third positive is securing supply chains. Now, we all remember during the pandemic, all of these supply chains that we never even realized were there, we were suddenly made aware of because they broke down. Pharmaceuticals in the West, their manufacture depended on raw materials which were exported from China, for example. Now, there is a strategic risk if you depend on countries which aren't necessarily your friends to provide those raw materials. So there is a strategic case to be made for reshoring or friendshoring some of those supply chains. But again, this goes way beyond just money. And there's a beautiful story which illustrates the effect of offshoring, the unintended consequences. And this is to do with manufacturing of Apple Mac Pros in the United States. So in 2012, Apple's chief executive, Tim Cook, he went on primetime TV and announced that Apple would make a Mac computer in the United States, which seemed great. It would be manufactured by American workers, and it was a top-of-the-line product at the time, and it was going to come with the inscription, "Assembled in the USA." However, when it actually came to the manufacture of the computers, the real problem was finding screws. Whereas in China, Apple could rely on manufacturers of screws to produce large numbers of custom screws on short notice, in Texas it turned out this wasn't possible. There just wasn't the manufacturing infrastructure to produce these custom screws. In turn, that hamstrung Apple's ability to turn out new computers. And in the end, you guessed it, they had to order those screws from China. And in an interview with 60 Minutes, Tim Cook talked about the reasons for outsourcing manufacture to China. And he said that it's not just about lower wages in China, which makes manufacturing cheaper, it's also a lot to do with skills. He says China put an enormous focus on manufacturing, and its schools prioritized vocational training. He said you could take every tool and die maker in the United States and fit them into the room we're sitting in, whereas in China you'd have to have multiple football fields. So if you do outsource manufacturing, it has all sorts of unpleasant consequences for your country. It obviously results in the loss of local jobs, but also the supply chains internally will die with that outsourcing, as we saw in the case of the screw manufacturing. You also lose the engineering skills that go along with that manufacturing, and of course the education that's required to create those skills. All of this knowledge dies. So one potential positive of tariffs is that employment increases in protected industries in your own country. Now, where does all of this stuff about globalization and outsourcing come from in the first place? Well, I think a lot of it comes from the idea of comparative advantage, which is the brainchild of David Ricardo. And it is a logical argument which makes a lot of sense, which is that for some countries, it's more cost effective to produce certain things. That suggests that they should specialize in the manufacture of those things at which they're best, then export those goods and services to other countries which specialize in different things. Another key concept here is opportunity cost. At the time of David Ricardo, the UK used to make a lot of high quality wool, and Portugal made a lot of high quality wine. So it made sense for the UK to produce lots of that wool, export it to Portugal, and import Portuguese wine. As long as the trade was roughly equal, it was fair trade, to use Trump's term. And it all hinges on this idea of opportunity cost and comparative advantage. However, the social cost of that globalization was essentially death of industries in certain places in America. For example, here you can see a steel factory which has since been torn down in Pennsylvania, because US steel wasn't cost effective using these comparative advantage arguments. Now, some of that dissatisfaction centers on wage inequality, but what is kind of interesting, and this is based on data from John Byrne-Murdoch of the FT, is if you look at overall wage inequality, it really hasn't changed much over the last 30 years or so. That's both for the US and the UK. However, what you can see is that if you compare the top 1% and the median, in other words, the highest paid jobs relative to the average person, that difference has grown larger. The ratio of the middle to the bottom has also decreased, which is good news if you're a very low wage earner, but not so great if you're in the middle. What you're seeing is your job not being so special as it was, certainly in terms of pay. And psychologically, that's going to be difficult. And as John Byrne-Murdoch says, in the 1980s, 40% of the highest paying jobs in America didn't require a degree. The upper reaches of the income scale included plenty of engineers and doctors, but also senior school teachers and the most skilled factory and construction workers. People from all sorts of backgrounds with all sorts of skill sets could dream of making it. That is the American dream. However, today, the upper part of the scale, that 1%, is dominated by highly skilled tech and healthcare workers. Almost half of the top jobs require an advanced degree, and a huge section of the population knows at a pretty early age that they're not on that path. So could tariffs turn things around? Well, there's an interesting paper that was published in 2019 which looked at this. So here, for example, in the left-hand panel, you can see those tariffs which were imposed on China and other countries, and the timeline of those tariffs being ramped up. And then the panel on the right shows the counter tariffs that were imposed on US exports. Now, the overall effect, certainly in the short term, was that despite being intended to boost manufacturing activity, the report found that US industries which were exposed to those tariff increases actually experienced a relative reduction in employment. So while the import protection certainly boosted employment by about 0.4 percentage points, there were two negative effects. One was rising input costs due to the tariffs imposed by other countries. That wiped off about 2% from employment, and retaliatory tariffs wiped off another 1.1%, such that the overall effect was a 2.7 percentage point fall in manufacturing employment. The report also breaks it down by county in the United States, and you can see the positive effect of import protection. That's the first graph. But once you take into account export retaliation and rising input costs, the overall effect on employment was negative. So while this was a fairly short-term effect, if you actually look over a longer period using something like a general equilibrium model, it turns out that the effects aren't quite so negative. Presumably that's because people actually start to buy those more expensive goods produced domestically because tariffs make them more competitive. And if we do look at the longer term, another problem which many people cite when it comes to tariffs, which is higher inflation, also might not be as severe as you expect. And this story focuses on washing machines and cars. Now there was an interesting thread on X. Here you can see a tweet from Oren Cass, where he's showing a graph from Justin Wolfers, which seemed to be trimmed for a certain period of time when it talks about laundry appliances, washing machines, and how their prices changed over time. What Oren Cass is saying is that the period chosen by Justin Wolfers was very selective, and it was chosen to show an increase in prices. It turns out if you extend the time series, then the effect on prices wasn't as extreme. Now, of course, inflation is usually taken as the year-on-year change in prices. So if you get a spike in prices due to tariffs, say, after a year has passed, usually what you see is that the comparison period has the spike drop out of it and inflation goes back to normal. And Cass points to an interesting example, which is the LG plant in Clarksville, that's in Tennessee, which was actually built before the tariffs were imposed by Trump first time around. As a result of the tariffs, LG expanded its US appliance production in Clarksville, and it earned a reward which is called the World Economic Forum's Lighthouse status for advanced manufacturing in this sector. And later on, it announced in 2023 that it would build a $3.2 billion factory in the same town for EV battery components. So if we do look over the longer term, you can see that the return of manufacturing to the United States, either directly or indirectly as a result of the tariffs, actually can have longer term positive effects. And if we look even further back in time, this is reminiscent of what happened in the 1980s with Japanese automobile imports. Now, this was the time of President Reagan, and he actually negotiated a voluntary export restraint with Japan's Ministry of International Trade and Industry. Now, the agreement said that Japan would limit its auto exports to the United States to around 1.7 million automobiles, and that would be frozen at the level from 1979 for 3 years. So while it wasn't called an import quota, that's what it was. However, Japanese automakers realized that they could manufacture automobiles in the United States, and they did so. Here you can see some of those factories and where they were located in the US. Now, of course, once that started, local supply chains started to spring up. It employed American workers, and of course, research and development centers were also created locally in the US. Then later on, the quotas were lifted because they weren't needed. Now, there was a temporary spike, a 15% spike, I believe, in car prices during this period, but eventually that subsided and we started to see the positive effect of manufacturing in the US take over. So I hope that's allowed you to see some of the potential benefits of tariffs. Yes, there could be a short-term effect on unemployment. The counter tariffs are really critical here because if they're very severe, the size of that pickup in unemployment could be larger and the negative effects on inflation could also be larger. But overall, I think over the longer term, you can see some of the benefits of tariffs. As I said at the beginning, I don't think it's clear cut. Now, as a global equity investor, I think a lot of the companies which dominate global indices at the moment are tech companies. Now, these won't be directly affected by the tariffs, so I don't expect there'll be a huge effect there. And so perhaps these companies can carry on making increasing profits and global indices won't be too negatively affected. Now, the AI story on which many of these mega cap tech stocks depend does depend on the manufacture of chips and the exports and imports of those chips. So as long as that isn't disrupted, then I think potentially this rally that we see over the last 2 years could continue. But if we are thinking over the longer term, I certainly think there are some benefits to tariffs. Now, don't forget our offer from Raisin. As a viewer of PensionCraft, you can receive a £100 bonus, and this is for a limited time only, if you register and fund your account with a minimum of £10,000 and use the code SAVINGS100. And you can find out more about that in the description below. And, as always, thank you for listening.